Asset impairments, profit margins, write-downs, all words you'll hear during a company's earnings report. But do you really know what these mean and how to use them to pick the best stocks? In this video, I'll explain the income statement, show you how professional analysts use this financial statement to analyze stocks. I'll then take you from the income statement basics to the financial ratios you need to know. We're talking income statements explained today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, it has never been easier to invest in stocks. From YouTube to investing blogs and CNBC, you can get 100 stock picks in an hour and 1-second trading execution on any brokerage platform. But until you know how to analyze the financial statements of a company, the reality is you're gambling more than investing. Until you can look for yourself and analyze that company's financial statements, you're dependent on what someone else is saying about stocks. But this video is your chance to break free on that dependency, and the income statement is where it's all going to start. In this video, I'll start you off with the basic understanding of that income statement, what it shows, and how to read it. Then we'll take a deeper look into how Wall Street analysts adjust and analyze this profit and loss statement. Finally, I'll reveal simple techniques you can use to analyze the income statements to pick the best stocks to buy. I'll add a clickable index in the video description below if you want to jump around a little bit, but please make sure you watch this basic explanation first so you have that understanding of what's easily the most popular financial statement for investors. Now, this is all part of a special investing education series that I'm starting, showing you what it really means to analyze and invest your own money. I'll be using content straight out of the curriculum for the Chartered Financial Analyst designation, the gold standard for stock analysts working on Wall Street. The designation involves 3 years of exams and thousands of pages of curriculum, but I'm going to be laying it all out for you in these videos. I'm going to be putting this one and all those videos into a playlist called How to Invest in Stocks here on the channel. Make sure you tap that subscribe button so you don't miss any of these, because I've got some great in-depth videos coming from options trading strategies to technical analysis and how to beat those investor behaviors that lose your money. Now, the income statement. This is one of the 3 financial statements released by a company every 3 months and every year. It shows the sales and profits of a company over that period and is easily the most popular of the 3 statements among investors. But this is also where you're going to find the most shenanigans in reporting. You see, management knows how intensely investors are watching those bottom line earnings, and often their own compensation is going to be tied to those income statement results. So there are just all kinds of tricks, most legal, but just a way of massaging the financials to make those earnings look as good as possible. So part of your job analyzing an income statement, something we're going to talk about here after the basics, is just going to be spotting those financial shenanigans, backing them out of those numbers to show a purer picture, a truer picture, and use that to do your analysis. To get started, there are a couple of places you can find the income statement, and really all 3 of these financial statements for a company. The best is always going to be directly from a company's investor relations page. Now, all publicly traded companies are required to have this page and have a quarterly and annual financial statements available to investors. Now, you'll look for a tab called the SEC filings or maybe financials, then download the 10Q, which is the quarterly earnings, or the 10K, which is the annual earnings report. You can also find the financial statements on any brokerage platform or most investing sites like Morningstar here. Let's run down each line of this income statement to see what it shows. Then I'm going to explain how an analyst is going to use this statement to analyze stocks. Here's Apple's income statement, and these all start with total revenue or net sales at the top. Now, this is the money collected from products and services, and here Apple is reporting net, so that's probably going to mean after rebates, discounts, and returns, and maybe some other items. Now, one thing you're going to notice here is that you have to be something of a financial detective when you're reading these financial statements and then doing your analysis. Maybe for brevity, maybe just to hide some details that don't look so good, maybe for other reasons, but companies just don't list out every possible item in their income statements. It's up to you to find those details that are going to matter. For example, again here, Apple doesn't tell you how it comes to this net sales number and what's it deducting from that total sales on the products. So what you need to do and what you're going to see down at the bottom here is a note that says, see accompanying notes to the financial statements. And there are really 2 places you're going to look for these details that you're going to need for your analysis. One of these is the footnotes, and another is what's called the Management Discussion and Analysis, or just MD&A. Now, this is where the company spells out what actually goes into each of these line items. So we've got this net revenue collected by the company after maybe those discounts, returns, and maybe even some production costs. And next, we're going to see this cost of sales. Now, this is mostly the cost of paying suppliers for those component parts for a product company like Apple. By comparison, for a service company like maybe Google, this is going to be cost of sales or cost of goods sold. And it might be something like paying acquisition costs from those other websites that show those Google ads. So this cost of sales line is really going to be the first expense a company is going to record. How much it costs to make those sales, whether through a subsidiary or paying suppliers for parts. And under this is our first big profitability measure, gross margin. Now, this is the revenue left over after paying those costs of goods, and something we'll talk about later in our income statement ratios. Next here is arguably the most important part of the income statement, even if Apple's leaves a lot to be desired in that detail, the operating expenses here. Now, these are all the expenses of running the business, those core costs to keep Apple running. Again, here it's pretty light on the detail with only the 2 lines for research and development and then selling, general, and administrative, which is also sometimes abbreviated as SG&A. That R&D is the key driver for any tech company, really spending to discover and develop those innovative products. Now, we'll talk about this more later, but be wary of any company cutting back on its R&D to boost its earnings, because it's probably going to mean slower sales growth in the future. This next line here, selling, general, and administrative, is just a catch-all that a lot of companies use and includes things like marketing, legal, salaries, rent, and utilities, pretty much all non-production spending. Now, it's not absolutely necessary to know exactly what goes into each of these down to the dollar. Okay, the company is going to break out a little bit more detail in the notes and the MD&A section. But it's really only critically important when you have to dig in to see why the expenses are increasing or decreasing, and then compare it to other company spending. Sometimes shown here in this operating expenses group is also going to be depreciation and amortization. And this is a really important item for those capital intensive companies like REITs, MLPs, energy companies, and utilities. Basically, what you're looking at here is a company can buy an asset like an oil field, and then instead of taking the whole price off as an expense in that quarter or in that year, it can take a portion of it each year for decades. And this is going to help smooth out that earnings effect, right? That smaller annual expense from depreciation only brings down earnings a little bit versus just that big write-off in the year the asset was bought. Next on the income statement is going to be our biggest profitability measure, the operating income and this operating margin. Now, the operating margin is that operating income, so the money left over after paying all those operating expenses divided by total sales. And this is by far my favorite financial ratio because it's really that core profitability of the company. How well is management doing converting those sales into operating profits before the effect of leverage and all the taxes? Now, most income statements are going to have a line for interest expense as well. This is the money the company pays on its debt. But again, Apple has left us a little in the dark here with this other income and expenses net item. But when you look in the notes on this, you see that it's a combination of the interest and dividend income that the company makes on its cash, plus that interest expense, which totaled nearly $2.9 billion in 2020. So not an insignificant expense and something that we'll need for one of our financial ratios later. Then you're going to see some kind of tax expense or this provision for income taxes. Now, understand that because the income statement isn't a cash statement, okay, it doesn't show actual cash in or out of the company. This is just going to be an estimate for taxes before the company actually pays them, but it's still really useful in our analysis. And finally here, you'll see the bottom line, net income. Now, this is also broken down into earnings per share, that net income available to shareholders both on a basic and diluted measure. And here, basic is just going to be all those shares outstanding currently. And that diluted, that's going to be all the stock options, convertible debt, and if all the possible stock conversions happened, how many shares would be issued in the market at that point. That's the basic outline for the income statement. And most income statements are going to look roughly like this. Now what I want to do, I want to show you how an analyst uses the statement and how to do your own adjustments for your analysis. First though, I want to get your idea on where everyone's at with this. What questions do you have about the income statement? So maybe watch through the video and then scroll down and let me know in the comments. What questions do you have and what do you want to know about the financial statements? So now an analyst's job is then to take these raw financial statements, the income statement, balance sheet, and that statement of cash flows, and they have to adjust them for, well, reality. And what I mean by that is that we've already seen how management has a motive to play around with these numbers just to make earnings look as good as possible. From booking sales that might never get paid for to not reporting expenses, there are a million and one shenanigans that can manipulate the income statement. In fact, I'll do a whole nother video just listing out these shenanigans and these financial statement tricks so you know what to watch for. But the analyst's job is just to remove all these financial tricks and then adjust the income statement to a truer picture of how the company actually did in the last quarter or in the last year. They can then take this picture and look for the trends in the company's profits or just compare it to another stock to pick the best investment. I'll show you those comparison techniques like how to do a common size income statement and then the ratios next. But first, let's look at some ways you need to adjust the statement to bring it back into reality. Don't forget to tap that subscribe button though so you don't miss our next video in the series where I'm going to be covering the statement of cash flows, by far the most important of these three financial statements. Now, analysts like myself, we spend the vast majority of our time on that cash flow statement because it's that actual cash coming in and out of the company without all these accounting tricks, so make sure you watch for that video. Again, here's a list of the adjustments analysts make with this income statement, and this is all going to start with an understanding of how the statement is put together, how companies actually report their sales and expenses. And I can already see a lot of eyes glossing over out there. I promise you don't need to be an accountant to understand this stuff. This is just basic understanding of the leeway management has in the way it reports these numbers, because it's not as simple as saying, okay, we sold this much this quarter and paid out this much. Now the difference here is that this income statement, it's not about cash. What we see here on the income statement, these numbers, this is not cash flow. The company might book a sale on a product, but if it makes it on credit, it's still going to report that as a revenue, but it's not actual cash coming into the company. Now I know that might seem like a trivial difference, but it's very important because this is a lot of how companies trick you. For example, if the company lowers its credit standards just to make more sales, even though it knows it's going to see higher non-payment for those, and those sales may never get paid for, it's still going to be able to boost its earnings in that quarter and that sales growth with the quarter or the year. So first here, you're going to need to adjust the sales or that revenue reported number. And here it's really about looking at how the company is booking its sales, whether those are really quality sales or maybe you need to adjust them a little lower for things like returns and non-payments. Now, one thing you can do here is look at what's called the allowance for doubtful accounts. That's going to be on the balance sheet. This is going to be under the accounts receivable line, which is all the sales the company has made on credit and it's still waiting for it to be paid on. Now here we see the Microsoft balance sheet, and you can see that they list out the accounts receivable net of doubtful accounts, but they also say that this amount is $610 million for the September quarter versus $788 million in the previous quarter. So really what Microsoft is saying here is that of those sales it made on credit, it's estimating that it won't be paid on just over $600 million of it. And what you would do as an analyst is keep a running record of this in a spreadsheet or something for every quarter, going back maybe years, just to see if there's any trend, like what percentage of this accounts receivable number is estimated to go unpaid. And again here, you're probably going to have to check in the notes section or that management discussion section to get some of the detail on this if they don't show it on that balance sheet, or just to see if management comments on any of the trends in this. But it's a big part of this kind of professional level analysis. Any change in the company's credit policy or an increase in doubtful accounts can be a huge red flag. And it's not just for catching those trends in a company either though, but comparing how management at one company maybe handles it versus another. For example, you can question, why does one company see so much higher unpaid sales? And this estimate for doubtful accounts, why is it higher than from one company than for another? And is that a sign of weakness in the business? When you're done adjusting these sales, now you move on to the expenses. Because there's really two ways for management to make those earnings look better, right? They can boost sales with maybe questionable credit policies or maybe not take out for estimated returns, or they can make expenses look lower. And there are a lot of shenanigans management likes to play here, but I want to cover the two most common here. First is just saying something is a long-term asset instead of a single-time expense. Now let me give you an example of this just to make it clear. Now we know that when a company pays for something during the quarter, whether it's marketing or advertising or whatever it may be, it's an expense. It's a cost the company paid. Now that money gets taken off the income statement and lowers its earnings. Now if a company buys an asset or spends money to develop an asset, something it can use to make more money in the future, For example, if it builds a factory, it spends money to build a factory that's going to last for years and help make money for years. So what the company can do with this, instead of saying that that money to build a factory was an expense, it can record it as an asset on the balance sheet. Then each year, as the factory gets older and has fewer years to produce, it can take a portion of that price paid as depreciation, and it takes that as an expense on the income statement. Well, this is just one of those big things that management can play around with to lower their expenses and make their earnings look higher. And the classic example of this is AOL. Now, you remember those annoying startup discs in the 90s, right? The CDs giving you 10 free hours of AOL. You got like 5 of them in the mail, or maybe I'm just old here. Anyway, those CDs cost AOL $21 million in 1995, which would have been a pretty big hit to earnings if they said that this was like a marketing expense and took that amount off the income statement all at once. But management has this bonus to think about. It doesn't want a $21 million hit to the earnings. So instead, AOL said that this was a deferred membership acquisition cost, like spending on all those CDs was going to get people to use the service over a period of years. So it put this money as an asset on the balance sheet and was going to depreciate that a little bit of that $21 million each year on the income statement. In effect, instead of that one-time hit of $21 million, it would take maybe $4 million of it each year as a depreciation expense, and those earnings would look better this year and next. Well, in reality, this was just a marketing expense. It should have been taken off as a one-time expense, and eventually management had to own up to that and redo its prior year income statements to adjust those numbers. But it's this kind of financial detective work that you need to do with these statements. What are the legitimate expenses, and is management trying to hide other costs that there should be on here? Now we're going to put all this to work with 2 ways to use the income statement to analyze stocks. These are actually really simple techniques, but it's still important that you have that understanding of the financial statements and be able to adjust them so you're comparing the right numbers when you go to do this kind of analysis. In fact, I built some of this analysis into our stock comparison spreadsheet, an Excel spreadsheet for comparing stocks and managing your portfolio. I'll leave a link in the video description below and a special discount, so make sure you check that out. Now we'll use 2 techniques for analyzing the income statement here: common size analysis and the income statement ratios. Now common size analysis is just taking each line as a percentage of sales. For example, how much a company's sales is it spending on R&D, that research and development, or how much in operating profit is it making? Now, the income statement ratios are just one number divided by another, and this is going to give us some great insight into profitability and valuation. Here I am on Morningstar on the income statement for Apple, and again, you can get this income statement directly from a company's investor relations page or most stock investing platforms. So I'll download it into an Excel spreadsheet, and this one is pretty basic, but it's going to work for our analysis example. If you were going to be doing this to really analyze a stock, you'd want more lines on this, detailing each individual expense and then adjusting for your own analysis. So this is just the basic data, and here I've copied this sheet to use for my own common size income statement. Now you see all the original numbers up here, and down here I've just taken each number and divided that by the year's total revenue. For example, if we take this cost of revenue cell for 2020 and then divide it by the total revenue just above it, I get 61.7%. And if I do the same for this gross profit underneath, I get a 38% gross margin. And then I did that for every line all the way down to net income and for every year. And you should be using the common size income statements in 2 ways here to analyze your stocks. First, it's a great way to spot those trends or the problems in a stock. For example, if I'm looking here at Apple, I can see its operating expenses have trended way up over the last decade, from just about 9% through 2015 to 14% of sales for this year, which is a really big increase. Just that 5% increase amounts to expenses increasing by $13.7 billion. So I definitely want to look into that. And so looking deeper at that, I can look at the 2 lines that they've broken it down into here: selling, general, and administrative costs, and then the research and development costs. And this SG&A number hasn't really come up much, from about 6.5% of sales earlier in the decade to just about 7%. So that's not really what's increasing here. It's this R&D number. That research and development costs have increased from about 2.76%, so just under 3% of sales in the first half of the decade, to 5.6% over the last 5 years. Really a doubling in this expense. So this would definitely be something I want to explore in the financial reports. Why are Apple's research and development costs rising so fast? Is this going to be the same for competitors? Is there like an arms race in R&D for consumer electronics? Is Apple converting this R&D spending into maintaining its competitive advantage, or is it just trying to keep up? And that's one way to use this common size income statement analysis, right? Spotting the trends, the problems, and maybe even the advantages in a stock. For example, if this percentage of net income to stockholders, this is the company's net profitability. If I saw this was rising, then that would be a very good sign for the shares. Another way to use this is not by comparing a stock against its own history though, but against another stock. So here I've done the same thing with Microsoft's income statement, and we can compare the trends as well here, as well as the most recent year's numbers to see which company is doing better on that kind of fundamental analysis. And if we just look at the profitability measures, the gross profit margin for Microsoft is almost 68%, which is really good for just about any industry, but especially against Apple's margin of 38% here. We also see that Microsoft has an operating profit margin of 37%. So remember, that means the company is able to convert 37% of its sales into profits after paying those operating expenses. And that's compared to just 24% for Apple. Now, maybe Microsoft and Apple aren't perfect comparisons anymore. Apple is almost a pure play consumer electronics company, while Microsoft is much more of that enterprise business and those other segments. But it's about as close as you get for that comparison. And that's what you really want to do here, okay? Remember, you always want to compare similar businesses when you're comparing stocks. If I were to compare the income statements for maybe Apple against, say, Johnson & Johnson, it really would tell me nothing because they are in completely different business models. Even as much as the profit margins were off between Apple and Microsoft, they're still going to be even more off with unrelated companies in different sectors of the economy. So if you're going to be comparing financials to see which stocks are really operating in the most efficient way, you've got to compare them against others in the same industry. And here we can go back to compare those income statements between Apple and Microsoft. And one thing we wanted to see is if those R&D costs for Microsoft were rising as fast as they were at Apple and really hitting that profitability. And we see that those costs have been fairly consistent over the last decade, averaging around 13% through this entire period. Now that's just a comparison of one company here, but if we found that same at other companies in the industry, we would really want to research why Apple R&D costs are rising and if it's just getting enough bang for its buck in these expenses. Another really interesting point that we didn't see just looking at Apple's income statement alone, but we see here in that comparison is that Microsoft has been able to lower its expenses for that selling, general, and administrative to just 17% of sales this year, and from 25% at the beginning of the decade. This is an amazing cost-cutting move, and if you do the numbers here, that amounts to a savings of almost $10 billion that can flow through to the profits. So that's the common size income statement technique and for this analysis. And again, if you were doing this for real, you'd really want more line items here. You'd want as much detail in all those expenses as possible, and you would want to adjust these statements like we looked at to make sure that the comparisons are all on the same level from company to company. Another use of the income statement is going to be those financial ratios, and some of these we've already looked at on the common size statement. And the most important income statement ratios we'll be using are the profit margins here. So that's gross, operating, and the net margin. These are the percentage of sales left over after different points in the statement and really how you measure that profitability for a company. The other financial ratios here are the times interest earned and the price multiples. So like price to earnings and price to sales. So let's take these one by one. I'll show you what each ratio means and how to find it. Now the gross margin is just the sales left over after paying those suppliers. So if we look at the Apple income statement, you're going to see that total revenue and then the cost of revenue, which is, again, Apple paying all those chip makers, the handset producers, everyone that supplies the company with their component parts. And if we take this gross profit margin divided by total sales, that gross margin, that's going to give us the first profitability measure. Now, just like the common size technique with these ratios, you're going to be watching the trend in the company as well as comparing them with other companies. And here in your analysis, it's really important not only to compare these ratios, but just to know what these profit margins are telling you about the company. So the gross margin, that's going to be the function of a few things here. First, the company's buying power over suppliers. Can it get those big discounts because it's a ginormous company like Apple? Also from the top line number, so that sales number, the total sales, maybe the company has just such a great product that it's pricing it higher than competitors. While the cost might be about the same, the cost of sales, that's why the gross margin is higher because the total revenue is so much higher. These are all things you want to be thinking about when you look at these ratios. We'll also look at those other two profitability measures here, the operating margin and the net margin. Now, operating profitability, that's the operating profit divided by the sales. That's really much more about how the company controls its internal costs. You see what comes out as expenses here after that gross profit number. It's the company's marketing, its administrative costs like staffing, its research and development for new products. So how well is the company managing these core costs to have how much left over in the operating profits as possible? And finally here, the net margin. That's the net income divided by total revenue. How much of the sales are left over after paying all those expenses, those interest, and the taxes? How much is left over for shareholders? Another important income statement ratio here is called the times interest earned. And this is just the EBIT, the earnings before interest and taxes, or just the operating profits usually. You take this number divided by the interest expense paid on debt. Now this measure is really useful in showing you how well a company can cover those regular interest payments with its earnings. And this isn't quite as important for Apple though, because it's got so little debt. You see here that while it has decreased a lot, Apple is still able to cover its interest payments by more than 20 times. Now I'd watch that it doesn't get much lower than this, but I have a feeling this measure is going to be getting even more important over the next few years after all these companies that have just loaded up on debt this year to fight that pandemic. So all your airlines, your cruise companies, all those retailers that have borrowed tens of billions of dollars, you really need to be watching and comparing this ratio. Finally here is every investor's favorites, the price multiples. How expensive is that stock? And two here we can use with the income statement are the price to sales and the price to earnings ratio. Now here I had to bring in the market cap of the company for each year. That's just the total market value of the shares, and you usually see this PE ratio on that per share basis, but you can also do it with the company-wide basis, and it's going to give you the same exact number. So I've got the total market value of all the shares here, and you can get that from any platform. Just look for the market cap. And then I take this number divided by each year's total revenue for that price to sales multiple. Or I can take it divided by the net income for that price to earnings multiple. And just look at these. Wow, what a change for Apple. And really kind of scary for investors that we might be in a tech bubble. We see that Apple traded for about 3 times sales all the way through 2018 and has just rocketed up since then, now trading at 7.5 times sales. Same thing with price to earnings ratio here, from 14 or 15 to 35 times earnings this year. Now, I'm not necessarily saying that the shares are ready for a drop, but just comparing those ratios against others and against other stocks. This is what you need to be doing when you're analyzing stocks to buy. Nation, I know it is a lot of work, and honestly, this is why most professional analysts stick to just working in a single sector or even a few industries. It's just impossible to do this level of analysis and keep it updated for every stock in the market. So put this analysis together on the stocks in an industry. You keep it safe so you don't have to recreate it every single time. Over the span of a few quarters, you're going to get to know that industry, how companies report their income statements, and just adjusting the numbers. So it's going to be like second nature for you. That's when you're going to start seeing those opportunities that other investors don't, because you're going to find that in-depth kind of analysis. Click on the video to the right for the first video in our series, 5 options trading strategies to lower your risk and boost returns. And be watching for our next video where I'll cover the statement of cash flows, easily the most important financial statement. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.